for young adults in the United States. The dream of buying a first home in 2025 feels less like a rite of passage and more like a cruel joke told at their expense. Because while previous generations were able to graduate, find a job, save for a down payment, and buy a motor starter home by their late 20s, today's young buyers are staring at a market where every step toward homeownership is like wading through wet cement while carrying a bag of bricks. Starting with the most obvious roadblock, prices that have outpaced wages for well over a decade. Home values nationally are up nearly 45% since before the pandemic and more than doubled since the late 1990s when adjusted for inflation. Yet median wages have barely moved in real terms, meaning the gap between what young adults earn and what homes cost has become a canyon that is almost impossible to cross without an inheritance, a windfall, or a winning lottery ticket. The median home price in mid-2025 hovers around $435,000, which for someone earning the U.S. median household income of about $75,000 means buying a home now would require spending far more than the recommended 30% of income on housing, closer to 40 or even 50%. Once today's mortgage rates are factored in, and that's assuming they can even get approved for a loan in the first place, mortgage rates have been stubbornly stuck around 6.7 to 7%. Which may not sound catastrophic to those who lived through the 1980s double-digit interest days. But in a world where home prices are already sky-high, even that relatively modest rate translates into massive monthly payments. For example, a $400,000 home with a 7% mortgage rate means roughly $2,700 a month before taxes and insurance, which for many young workers is equivalent to rent plus student loans plus groceries combined. And speaking of student loans, today's younger generation carries more educational debt than any in U.S. history, with the average borrower between $30,000 and $40,000 upon graduation. That not only eats into their monthly budgets, but also drags down their credit scores and raises their debt-to-income ratios, both of which make mortgage qualification harder. Adding car loans, credit card debt, and the rising cost of essentials like healthcare and groceries, and the idea of saving tens of thousands for a down payment starts to look like saving for a trip to Mars. Theoretically possible but wildly unrealistic for most. Even those who manage to scrape together a down payment, often with help from parents or by draining retirement accounts, face the brutal reality of low housing supply. Thanks to the so-called lock-in effect, millions of existing homeowners are clinging to their pandemic-era mortgage rates of 3% or less and refusing to sell, because doing so would mean taking on a much higher rate for their next home. This has created a bottleneck in inventory, especially in the affordable starter home category, and when those rare listings appear, they're often snatched up by investors or cash buyers within days. According to recent data, about 30% of single-family homes purchased in the first half of 2025 went to investors, many of whom paid in cash and then turned the properties into rentals, further tightening the supply for would-be first-time buyers. In some cities, young adults are competing not just with each other, but with entire hedge funds and private equity firms that can outbid them without blinking, making the whole process feel less like a fair competition and more like a rigged game. And when a young buyer finally does find a home they can afford, perhaps in a less desirable neighborhood or in a town far from their job, they may discover that the property needs major repairs, comes with sky-high property taxes, or has insurance costs that blow up their budget, especially in climate-vulnerable areas where premiums have doubled or tripled in just a few years. Then there's the issue of wages versus cost of living. While the average hourly wage has seen nominal increases, inflation has eaten away much of that gain, and essentials like rent, utilities, and food have climbed at rates that outpace income growth. For many young adults, this means they re-stuck in a cycle of renting, because they can save enough each month to build a meaningful down payment fund. Renting itself isn't cheap either in many metro areas. The median rent for a one-bedroom apartment is $1,700 or more, which can be nearly as expensive as a mortgage, but without the benefit of building equity. This creates a catch-22. You need to save to buy a home, but higher rent keeps you from saving, and without owning property, you miss out on the wealth building that homeownership has traditionally provided in the U.S. Generational comparisons make the situation feel even more unfair. In 1980, the median home price was about 3 times the median household income. Today, it's closer to 6 times, and in expansive coastal cities it can be 10 to 12 times. Baby boomers often bought their first homes in their 20s with little or no student debt, stable job prospects, and mortgage rates that, while sometimes high, were paired with much lower home prices. In contrast, millennials and Gen Z are entering a housing market where even modest homes feel out of reach, forcing many to delay not only buying a home, but also major life milestones like marriage and having children. Living with parents into the late 20s or even 30s has become common, not necessarily out of choice but as a survival strategy to save money. While previous generations saw this as a sign of failure, today it's often the only practical way to get ahead financially. Geography plays a major role in this struggle as well. In high-cost markets like San Francisco, Los Angeles, New York, Seattle, and Boston, median home prices are so inflated that even households earning well above the national median struggle to buy. Moving to more affordable areas sounds like a solution, But this too has drawbacks. Remote work opportunities have shrunk compared to the early pandemic boom, so relocating to a cheaper region may mean accepting lower wages or fewer career prospects. And as migration patterns shift especially towards Sunbelt states, those cheaper markets are seeing their own price surges, quickly erasing the affordability advantage they once had. Cities like Austin, Phoenix, Nashville, and Tampa have seen double-digit price growth in recent years, driven in part by influxes of remote workers and retirees bringing cash from more expensive regions. Even government programs designed to help first-time buyers have limits. FHA loans allow for lower down payments, but come with costly mortgage insurance premiums that add hundreds to monthly payments. State and local down payment assistance programs exist, but they're often underfunded, competitive, and geographically limited. Tax incentives for first-time buyers are minimal compared to the break that existing homeowners get through the mortgage interest deduction. And while policymakers talk about the need for more affordable housing, zoning laws and high construction costs keep supply constrained, especially for entry-level homes. Culturally, young adults also face mixed messages. They're told homeownership is the ultimate financial goal, the ticket to stability and generational wealth, but at the same time, they're bombarded with headlines about housing bubbles, market crashes, and the risks of buying at the peak. Some fear that if they somehow manage to buy now, they could see their home's value drop in a downturn, leaving them underwater on their mortgage. Others worry about locking themselves into a long-term commitment that limits mobility in a volatile job market where layoffs and industry shifts are common. These anxieties, paired with the very real financial barriers, have led to a growing sense of resignation among younger generations, with some openly questioning whether homeownership is even worth the struggle anymore. And yet, the desire to own a home remains strong. Surveys consistently show that most millennials and Gen Z adults still see buying a home as a major life goal, a marker of success, and a key part of the American dream. The challenge is finding a way to make that dream attainable in a market that seems designed to keep them out. This might mean getting creative, buying with friends or siblings to pool resources, considering multifamily properties to generate rental income, or moving to smaller cities and rural areas where prices are lower. But even these strategies come with trade-offs in terms of lifestyle, career, and long-term value growth. Ultimately, the difficulties young adults face in buying a home in the U.S. today are the result of multiple intertwined factors. Decades of underbuilding, restrictive zoning, skyrocketing prices, stagnant wages, crushing student debt, high interest rates, investor competition, and persistent cultural and economic pressures. Solving this crisis will require more than just waiting for mortgage rates to drop. It will take systemic changes in housing policy, targeted financial assistance for first-time buyers, and a cultural shift in how we define success and stability. Until then, young adults will continue to face an uphill battle, climbing toward a dream that feels farther away than ever, all while juggling rent, debt, and the unpredictable realities of the modern economy.